The Bank of Japan just did something the herd completely misjudged. They are about to hike rates to a level not seen in 31 years, and yet, the yen might not rally. It might collapse. Most traders are staring at the wrong signal, and that creates a massive trap right now. In the next 15 minutes, I'm going to show you exactly where the danger zone sits, where the hidden opportunity lies, and why one number on your screen separates the winners from the losers. Stay to the end. I'm giving you 3 exact levels you can trade tomorrow. This is US dollar to Japanese yen, current price 160.23. The session bias is bullish continuation out of a tight consolidation. The monthly trend, strong buy. The weekly trend, strong buy. The daily trend, strong buy. But here is the first critical insight. The 5-hour and the 1-hour have flipped neutral. That means we are coiling energy right at a major decision point, and that decision point has a name. Pivot 160.14. The market is compressing exactly around this number, waiting for the Bank of Japan to drop its decision, and that decision is a trapdoor. Write this number down right now. If we close below 159.15 on the daily chart, the entire bullish structure resets. That is your invalidation line. Below that, the trend flips, and we start talking about a deeper correction toward 158.66. But as long as we hold above 159.15, every dip is being bought by institutions that understand something the retail crowd does not. The herd is positioned for a hawkish BOJ surprise. They are long yen, short dollar yen. The speculative positioning data shows a massive build in yen longs going into this meeting, thinking a 31-year high rate hike must send the pair lower. But what they are missing is the second half of the headline. The Bank of Japan is set to drop hawkish signals. That means after the hike, they signal they're done. No further tightening. This is the classic dovish hike, and it is a trap that squeezes the late yen longs into a panic unwind. That unwind targets 160.64 first, and then 161.63. Let me walk you through the technical deep dive so you see exactly how this trap is built on the chart. Start on the weekly time frame. The 200-week moving average is a ghost far below us, but the 20-week moving average at roughly 158.96 has been acting as dynamic support for the entire rally. Every weekly close has printed above it for months. The ADX on the daily chart is sitting at 43.4. That is a number that screams trend strength. Anything above 40 tells you the trend is not tired. It is just breathing. The daily MACD is printing 0.42, firmly positive, and the signal line has not crossed bearish. That is not a topping pattern. It is a pause pattern. Now, here is what most traders miss. Drop down to the 4-hour chart, and you will find a hidden bullish divergence. The price has been making shallow higher lows. We bottomed at 159.15 and then held 159.65, while the 4-hour MACD histogram printed a slightly lower low. That divergence is not bearish. It is hidden bullish divergence. It tells you that momentum is reloading inside the trend, and it usually resolves with an explosive leg higher. The market is building energy exactly as the news hits. That is not an accident. That is how smart money loads before the event. Let's layer in the exact support and resistance levels you need tattooed on your brain. Pivot point 160.14. That is the bull-bear line for the intraday session. Above it, the path of least resistance is higher. Below it, we test the first support at 159.65, the 20-period moving average on the 4-hour chart, which also aligns with the daily MA5. Below that, we have S2 at 159.15. This is the structural floor. A break below 159.15 opens S3 at 158.66, which is the last level before a trend reset. On the resistance side, the first hurdle is a 1 at 160.64. This level has been tested twice and held. The more times a level is tested, the weaker it becomes, but also the more explosive the break. Above that, R2 at 161.13, and then the big target, R3 at 161.63. The daily ATR is only 48 pips, so the market is moving in tight compressed ranges. That compression in front of a central bank decision is a powder keg. A daily close above 160.64 almost certainly triggers a momentum chase that measures straight to 161.63. But you cannot just look at the chart in isolation. You have to understand why US dollar to Japanese yen behaves so differently. This pair is not just a Forex ticker. It is the heartbeat of the global carry trade. The yield differential between US Treasuries and Japanese government bonds is the real driver. Right now, the US 10-year yield is sticky above 4.5%, while the Bank of Japan is still capping the JGB 10-year yield around 1%. That spread is over 350 basis points. Even with the BOJ hiking to 0.5%, the highest in 31 years, the spread hardly shrinks. And because they are dropping hawkish signals, the market will immediately price out future hikes. The Japanese yield curve will barely budge, while US yields could tick higher on a hawkish hold from the Fed later. That is yield differential drama widening, and it sends US dollar to Japanese yen higher, not lower. This is why the pair keeps shrugging off intervention fears. The intervention ghost is real, but it haunts differently than most people think. The Ministry of Finance does not intervene just because the level is high. They intervene when the move is disorderly, speculative, and one-sided. Right now, with the BOJ effectively endorsing a weaker yen through a dovish hike, the move is fundamentally justified. Institutions are not panic buying dollar yen. They are slowly rotating out of yen carry trade shorts that got too crowded. The intervention risk is not at 160. It is probably at 163 or 165, and only if we spike 50 pips in 5 minutes. That is not the current structure. So the ghost is there, but it is not a reason to short. It is a reason to trail stops tighter when we hit the measured move. Let me give you the 1 to 2 week directional lean. The path of least resistance remains higher as long as the daily close stays above 159.15. The fundamental trigger is this BOJ meeting, but the follow-through fuel is the widening yield spread and the squeeze positioning. I want you to watch the Tokyo Open after the decision. If we spike lower first, say to 159.65, and then immediately recover above 160.14, that is the trap springing in real time. The invalidation for this entire bullish thesis is a daily close below 158.66. That would mean the BOJ did something genuinely hawkish that we did not expect, and the yield spread compresses sharply. If that happens, we cut longs and reassess. But right now, the asymmetry favors the upside. Do you think the dollar breaks 161.63 this week? Comment yes or no right now in the chat. I'm tracking consensus, and I'll share the poll results in tomorrow's video. Now, this is the section where most people click away, and that is exactly where the money is made. Keep watching, because I'm about to hand you 3 concrete trade setups with exact entries, stops, and targets, and the on-screen plan will be there for you to screenshot. Strategy 1. The sniper. This is the conservative play, the one that waits for confirmation that the trap has fired. The trigger condition is a 1-hour candle close above 160.64. Not a wick, not a spike, a full candle close above resistance O1. That close confirms the compression break and the start of the momentum leg. The entry is on the close of that candle, around 160.65 or better. Stop loss sits at 160.00. Why 160? Because that is below the pivot 160.14 and below the intraday value area. It gives the trade room to breathe without getting caught in the noise. Take profit 1 is 161.13. That is the next resistance and a logical level where fast money takes partial profits. Take profit 2 is 161.63, the R3 target and the measured move from the consolidation range. The risk-reward on this setup is 1 to 2.8. The entire setup is void if a 4-hour candle closes back below 160.14. That would mean the breakout failed and the trap did not spring the sniper, conservative, entry, 160.65, on 1H close above 160.64, stop loss, 160.00 take profit 1, 161.13 take profit 2, 161.63 risk. Reward, 1:2.8 R invalidation, Void if 4H candle closes below 160.14. Strategy 2. The active trader. This is for the trader who wants to enter before the breakout, using the compression zone as a launch pad. The setup is a buy limit at 159.80, with the entry condition that the 1-hour chart prints a bullish engulfing candle off the 20-period moving average that sits at 159.73. That moving average is rising and has held a support on every dip for the last 3 days. Stop loss goes at 159.40, just below the S1 support and the recent swing low, giving you a 30 pip stop. Take profit 1 is 160.64. When that is hit, you move your stop to break even and let the rest run for take profit 2 at 161.13. If we accelerate, you can trail the stop by the 5-minute 20-period moving average to capture a potential extension to 161.63. The risk-reward on the initial play is 1 to 2.2. The invalidation for this setup is a daily close below 159.15. If that happens, the structure is broken and you exit regardless. The active trader, standard, entry, 159.80, limit, after 1 hour bullish engulfing off MA20, stop loss, 159.40 take profit 1, 160.64 take profit 2, 161.13 risk, reward, 1:2.2 hour invalidation. Void if daily close below 159.15. Type your US dollar to Japanese yen range for tomorrow in the comments right now. Let's see who's aligned with the smart money. Strategy 3. The aggressor. This is the high risk, high reward scalp. It is a counter trend play against the initial spike on the BOJ headline. The market frequently overshoots in the first 30 seconds after the statement, only to retrace sharply when the dovish language is absorbed. The entry is a sell limit at 161.13, anticipating that a spike into a 2 exhausts the intraday momentum before the larger trend resumes. Stop loss is tight at 161.48, just above the R3 level. If price breaks above 161.48, the spike is not fading and you exit immediately. Take profit 1 is 160.64, which is the breakout level and magnet. Take profit 2 is 160.14, the pivot. The risk-reward on this is roughly 1 to 1.5, but the win rate on these BOJ spike fades is high if you are disciplined. I only recommend this for traders who can manage risk aggressively and accept that a stop-out is part of the process. Never risk more than 0.5% on this play, and if the candle doesn't reject a 2 within 15 minutes, close it manually to the aggressor, high risk, entry. 161.13, sell limit, stop loss, 161.48 take profit 1, 160.64 take profit 2, 160.14 risk, reward, 1:1.5 hour invalidation. Void if 1H candle closes above 161.50. Risk management pulse. Never risk more than 1 to 2% of your account on any single trade. No positions through high-impact news unless you are using the aggressor play with a micro lot. Stops are non-negotiable. Trading without a stop in a BOJ meeting is account suicide. Survive to trade the next big move. Here is your closing plan. The single most critical level for the next session is 160.64. A 4-hour close above that number opens the gates for 161.63 and likely a new yearly high within 2 days. Below 159.15, and the entire thesis dies. Tomorrow's wildcard is the Bank of Japan press conference. Governor Ueda will speak roughly 3 hours after the statement. If his tone is even slightly more cautious than the dovish statement implies, the yen could reverse violently. That is why I want you watching the real-time yield spread between the US 2-year and the Japanese 2-year. If that spread starts to shrink by more than 5 basis points during the press conference, get defensive on longs immediately. If you want my full breakdown on Bitcoin and the S&P divergence that is developing right now, that video is live now. Tap the end screen. Smash like if this gave you a clear, tradable plan. Subscribe, hit the bell, and I'll see you in the next one, before the next explosive move catches the herd off guard.